If you are 65 or older, Washington just slipped an extra $6,000 into the tax code, a brand new deduction hiding in plain sight with your name on it that can wipe out a big chunk of your federal tax bill. But here's the cruel twist. Most seniors are about to believe a myth about it that quietly costs them money. And the folks who understand the fine print will keep hundreds, sometimes thousands, more than the ones who don't. Hi, I'm Alex. If you're over 65 or you help your parents with their taxes, pull up a chair because this new break is real, it is big, and it is temporary. And almost nobody is explaining it to you straight. So here's my promise. In the next few minutes, I'll show you exactly what this $6,000 senior deduction is, who gets it, the income trap that can snatch it away, and the simple moves that keep more of it in your pocket. No jargon, no politics, just the plain math, the way I'd explain it to my own mom and dad. Let's start by killing the biggest myth because it is everywhere. You've probably heard somebody say, "Great news, they finally eliminated taxes on Social Security." I need you to hear me clearly. That is not what happened. Your Social Security benefits are taxed under the exact same rules as before. What actually passed is different and in many cases better. Instead of touching the Social Security rules, Congress created a brand new deduction just for people 65 and older. Why does that distinction matter? Because if you believe the myth, you'll plan wrong. You might skip the very moves that unlock this deduction and hand the tax man money you never had to pay. So let's get concrete. For your taxes this year, the 2026 return you're planning for right now, every American 65 and older can claim an extra $6,000 deduction. And if you're married and both of you are 65 or older, that's $6,000 each, $12,000 knocked right off your taxable income. And here's the part people miss. You get this whether you take the standard deduction or you itemize. That is rare. Most deductions make you choose one or the other. This one just stacks on top. Picture it like a layer cake, your regular standard deduction on the bottom. Then the extra senior deduction you already got just for turning 65. And now a brand new $6,000 layer on top of all of it. For a married couple, the standard deduction plus these senior add-ons can push your combined deduction up to around $47,500. That's tens of thousands of dollars of income the government simply does not tax. Now, who exactly gets it? The rule is refreshingly simple. You must be 65 or older by the end of the tax year. Even if you turn 65 on December 31st, you count for the whole year. You also need a valid Social Security number, and if you're married, you generally have to file jointly to claim it. File separately, and you can lose the whole thing. But there is one more catch, and this is the big one, the one that decides whether you keep all $6,000 or watch it quietly melt away. This deduction has an income limit, and it doesn't just switch off, it fades out slowly as your income climbs. The tax world calls this a phase out, and it's exactly where good people get ambushed. Here's how it works. If you're single, you keep the full $6,000 as long as your income, technically your modified adjusted gross income, stays at or below $75,000. If you're married, filing jointly, that line sits higher at $150,000. Stay below it, and the two of you get the full amount. But cross that line and the deduction starts shrinking. For every $1,000 you go over the limit, you lose $60 of the deduction. Keep climbing and eventually it's gone completely. For a single filer, the deduction hits zero at $175,000 of income. For a couple, it's gone at $250,000. So this is really a benefit aimed squarely at middle-income retirees. If you're comfortable but not wealthy, this break was written for you. And here's the trap that catches good people. Your income in retirement isn't always steady. One big move in a single year, and you can accidentally launch yourself over that line and lose the deduction without ever realizing it. A large withdrawal from your traditional retirement account. A Roth conversion done at the wrong time. Selling a stock or a piece of property with a big gain. Even a required distribution that turns out bigger than you expected. Any one of those can spike your income for the year, push you over the threshold, and quietly shave hundreds of dollars off your deduction. Let me make this real with two neighbors. Both single, both 70 years old, living on the same quiet street. Neighbor 1 keeps her income right around $70,000. She stays under the line, so she claims the full $6,000 deduction. At her tax rate, that's real money handed back to her. Neighbor 2 does a big Roth conversion and pushes his income to $125,000. He's $50,000 over the line, so he loses $3,000 of his deduction. Same age, same break on paper, but half of it is simply gone. Nothing about neighbor 2 was reckless, he just didn't know the line was there. And that's the whole point of this video, to make sure you can see the line everybody else keeps tripping over. So let's talk about how you keep more of this deduction. 5 simple moves. None of them require a finance degree, and any one of them could be worth real money. Move 1. Know your number. Before you do anything big with money this year, find out roughly where your income is going to land. $75,000 if you're single, $150,000 if you're married, those are the lines to watch. Move 2. Spread out your big withdrawals. If you need a large sum from a retirement account, ask whether you can split it across 2 tax years instead of taking it all at once. 2 smaller bumps may keep you under the line in both years. Move 3, and this one is powerful. Time your Roth conversions. Conversions are wonderful for the long run, but they add to your income right now. In a year you want this deduction, go smaller. Or do the conversion in a year your income is already high and the deduction is gone anyway. Move 4. Mind your capital gains. Selling an investment or a property with a big profit can shove your income over the line. If you can, take your gains in smaller slices, or in a year you weren't going to qualify anyway. Move 5. Coordinate as a couple. If you're married and only one of you is 65, you get just one $6,000 deduction this year. But next year, when the second spouse turns 65, it doubles. Plan your big income moves around that. Do these and you're no longer guessing. You're steering your income on purpose, keeping your deduction whole, and paying the tax man exactly what you owe and not a single dollar more. Here's a bonus connection most people never make. Lowering your taxable income with this deduction can also lower how much of your Social Security itself gets taxed. Remember, depending on your income, up to 85% of your Social Security benefits can be taxable. Push your income down, and you may quietly slip into a zone where less of that benefit gets taxed at all. So this one deduction can hit you twice, in a good way. It cuts your taxable income directly, and it can soften the tax on your Social Security at the same time. 2 wins from a single move. Now, the catch you cannot ignore. This is temporary. The $6,000 senior deduction is written to last only 4 years. 2025 through 2028. Unless Congress extends it, the deduction simply disappears after 2028. So think of this as a 4-year window to lean into, not something you can assume will be there forever, which means the planning you do in these few years matters more, not less. This is exactly the time to be intentional and deliberate about your income. Before we wrap, let me name the mistakes I keep seeing good people about to make with this. Mistake 1. Assuming your tax software or your preparer will just handle it automatically. Most will, but check. Make sure the senior deduction actually shows up on your finished return before you sign it. Mistake 2. Filing separately when you're married and accidentally throwing the whole deduction away. If you're not certain which way to file, ask somebody before you send it in. Mistake 3. Doing a giant Roth conversion or a big withdrawal in December without checking the line first. 5 minutes of simple math could save you $1,000. So who wins the most here? Middle-income retirees. Folks living on Social Security plus a modest pension or modest withdrawals. The people sitting right under those income lines. If that's you, this deduction could erase a big slice of your federal tax. For some lower-income seniors, it can wipe out their federal income tax for the year entirely. And if you're sitting a little over the line, now you know the exact moves that can pull you back under and claw some of that deduction back. All right, let's pull the whole thing together in one breath. There is a brand new $6,000 deduction for every American 65 and older, $12,000 for couples. It stacks on top of your standard deduction. It fades out between $75,000 and $175,000 for singles and $150,000 and $250,000 for couples. It is not no tax on Social Security. It's better understood and better used. And it is only here through 2028. Listen, I got tired of watching good people overpay the tax man simply because nobody explained the rules in plain English. So I dug into all of this so you wouldn't have to. If it helped you, do me one favor. Share it with somebody over 65 who files taxes. A neighbor, a parent, a friend at church. And if you want more plain English money talk for folks over 60, no jargon, no scare tactics, just the straight story, follow along and stick around. I'll keep explaining it the way I'd want it explained to my own parents. Take care of yourselves out there, and don't you dare leave $6,000 on the table. It's got your name on it.